What's up, guys? It's Caleb, and today I'm going to go over exactly how to make money in the stock market. I'm going to go over 3 main points, and those are going to be what you should be buying, when you should be buying, and how much you should be buying. There's different levels to the stock market, and you got to know kind of where you are in terms of your financials and how much money you've got around to invest. I'm going to go over portfolio management, the do's and the do not do's. We don't want any steps backwards. And in my opinion, I think this is going to be one of the most important videos on stocks you will ever watch, if not the most important. And if you guys like the video, please give it a like. I'm really starting to improve the channel, better quality on this video. And if you want to stick around for more videos just like this, please subscribe. So, first of all, why should anyone want to invest in the stock market or individual stocks in general? Because some people say it can be risky and you can lose some money. Well, the stock market is one of the best investment vehicles, if not the best investment vehicle. Individual stocks can have far better returns than index funds and mutual funds. Even if the percentage beat is kind of small, the compounding interest of those percentages add up over the years, and it makes a huge difference. So I'm going to go over first things first. You're going to need a brokerage account, and you're going to need some cash in it. So brokerages don't exactly matter a ton. I mean, some of the better ones are like Ameritrade, Fidelity, Schwab. So once you have your brokerage account and you got your money in it, now you're ready to buy stocks. But first of all, you need to take a step back. You need to understand where you're at. Like I said, there's levels to this. So if you have 0 to 10K, you should be invested in about 1 to 3 stocks. 10K to 50K, about 3 to 7 stocks. And 50K to 100K, you can have like 7 to 10 stocks. So 20 stocks or more is too many for almost anybody. And there's a couple of reasons for that. When earnings season rolls around and all these companies are reporting and you got all these numbers everywhere, you have conference calls coming out, and all the news, it's just too much. Like, you can't keep track of that many companies doing it well. And plus, over diversification is going to kill your gains. So you really need to know your companies inside and out, and you're only going to get that from having a limited number of companies that you can keep track of. So before you buy any company at all, there are a few things you need to do. And this is mandatory, and it's the bare minimum, okay? So first of all, you got to fully understand the business model of the company. That's basically how the company makes money, what the product is, what they do. You need to understand that. If you're buying some tech software company and they have good revenue growth and good income growth, but you don't really know like how they make money, that's never a good sign. That's not going to give you the confidence you need to hold that investment. So you need to read their entire 10K annual report and their 10Q. This is the most important stuff of all. The 10K is so critical. It tells you everything the business does, essentially, exactly how they make money, the risk factors. It shows you their net income and their revenue over the years, their debt, everything. This is really important. I generally read the first 1 through 40 pages of the 10K, and that'll include all the risk factors, everything about the business model. And then what I'll do is I'll go over the revenue or the balance sheet and the income statement, and I'll go over those things. So after you read their 10K and their 10Q, and you can find those on their investor page, just search the company and then type in so-and-so, which is the company, investor page, and it'll pop up, and you'll be able to get links to the SEC filings, which is what you want to read and what you want to look at. And I know it's going to be a lot of work, but trust me, it needs to be done. Every great investor does it, and it's how you make money in the long run. It builds confidence. You know exactly what the company does. It's really important. So the next thing you need to do is you need to listen to the company's conference call. The conference call is kind of like it's an update on the business. So you're listening to the conference call. There's going to be several people that talk. It's going to be basically everybody in control of the company, the CEO, the CFO, basically anybody that is helping the company run and go through its day-to-day activities. That's going to be really important because it's going to tell you how your company's doing. They're going to give an outlook on what the future's like, give the numbers of what they got versus what was expected. It's really important, and it happens 4 times a year. So every quarter, there's a conference call, and that's going to be really important to listen to because it keeps you updated on your company. And that, yeah, like I said earlier, that's why you can't have too many companies, because earnings season rolls around. They're about an hour long. So if you get 20 hours worth of conference calls, I mean, you're not going to listen to all that. So, keep it on the lower number of stocks, at least for when you're beginning. So after I read the 10K, I read the 10Q, I know how they make money. Then the next things I look at are the valuations. So you can look at the valuations by looking at price to earnings ratios, or PEs. Trailing PEs are good, but what you really want to look at is the forward PE. And the forward PE is basically analysts' expectations about how much money the company is going to earn versus their price. And it'll basically tell you what the stock's prices looks like now. So if I have a company that's going to grow net income at expected, so if I have a company that maybe last year they earned like 10 cents, so their P is say like 1,000, but over the next few years or over the next few quarters, if their net income is supposed to grow 50%, I mean, yeah, that trailing P of 1,000 looks huge, but they're going to be growing net income at 50% year over year. So really, they're not as expensive as we think, because we're not looking to the future, we're just looking at the past. So looking at the future is always really important. Forward PEs are one of the most important ratios you can look at. And then what I like to do is, like I said, I'll look at the income statement on the balance sheet. What you really want to see for a company is you want to see revenue that's growing sequentially. Year over year, you want higher and higher revenue numbers. And similarly with the net income, you want to see higher and higher net income numbers. It means the company's growing, becoming more profitable. And especially when you're beginning, I mean, sometimes you can invest in unprofitable companies. And if you know the business well and you think they're going to turn a profit in the future or the near future, but at least for when you're beginning, you want to invest in profitable companies because they're less volatile and less risky. So say you went through a company, you know everything about it, you read their 10K, listen to their conference call, they have good revenue growth, good net income growth, the company's great. So now you want to start thinking about what are the future prospects, or what's your bullish thesis for the company? Okay, so you know everything in the past about the company, but what about in the future? What are the catalysts that the company has that's going to make them grow in the future? For example, a stock like Chegg, it's an online tutoring platform. What is the catalyst that's going to help that grow? Everybody just got switched to online learning. Everybody's learning school from home. So maybe an online tutor is going to help. And it showed they had 63% revenue growth last quarter. Things like that. Another really important thing is you want companies with a lot of cash in low to little to no debt, because they're just in a safe position. I mean, if they need to make an acquisition or if they get hit with some lawsuit, they need to have money around to take care of it. So companies with a lot of cash are always much safer than ones that don't. Another thing I like to do, this is another really important thing to do to decide if a stock is a buy or not, is you want to watch interviews of the CEO. So the CEO is arguably the most important figure of a company, and you want to know what their thought process is, what their vision is, because that's going to help you look towards the future of the company. If you know what the CEO thinks, I mean, you basically know where the company is headed towards because he's the one guiding it. So that's really important. You should always at least watch a couple of videos of the CEO. If you're not going to look at anything other in the management team, definitely watch some YouTube videos about the CEO. So yeah, you might be thinking, that's a lot of work. Like, I don't really want to do that. But listen, I'm going to explain to you why those steps are important. Those steps are very important because they build confidence to hold the stock. Say you're down 20%. Where are you going to get the confidence to hold the stock if you didn't do any of that research? You might as well just be like, oh, I'm an idiot. Like, I'm just going to sell out. Like, I should never invest in this company. But then next thing you know, over the next 3 to 5 years, the company doubles, triples, quadruples, and you sold it out because you were down 20% because you didn't have the confidence, because you didn't read about the company. You know what I'm saying? And it works on the flip side too. So say you're up 20% like really quickly. Say you buy it in the next 2 weeks, you're up 20%. And you're like, wow, this is great. Like, I'm just going to sell and take my gains. But then in the next 3 to 5 years, the company doubles up, triples up, quadruples up. And you're sitting here upset because you sold the stock. But it's because you didn't have the long-term vision. You didn't do the research. So you were content with a 20% gain. When if you did the research, you could see, oh my gosh, this company is going to be massive in the future. Like, I'm just going to hold, right? So all of these things ties into being a successful investor and achieving substantial returns. So, all right, you found you're looking in, you know what to do, what to look in for stocks. You got a brokerage account, you got cash, you know what you're looking for. So portfolio management is very important. So your first as well as your biggest positions should always be big name, big brand, and dominant companies that consistently grow their revenue and their net income year over year. They got to have solid balance sheets and acceptable valuations, like a forward PE around 20. So think about companies like Facebook, Google, Amazon. These are the companies you kind of want to build your portfolio around. They build a solid, fundamental, kind of like a backbone to your portfolio. So if anything happens, anything bad happens to some, maybe you have some more speculative stocks or some of the stocks you have aren't so great, you always have that big name, big brand, very powerful, strong, well-known company, to kind of hold your portfolio up. So like I said, you found your first stock. So say you found your first stock, Google, Facebook, or Amazon, or you found like 3 stocks. So now what? You haven't done anything. You haven't bought anything. Now you want to buy in chunks. So you should never buy all your stock at once, and you should never sell it all at once. So let me give you some examples. So say you buy all your position at once. Say you have $1,000 and you see Facebook stock and you're like, I'm going to buy $1,000 of Facebook stock. So worst case scenario, what's going to happen? Say the stock drops 20, 30%. You're down 20, 30%. Like you can't do anything. You don't have any cash. You just bought it all immediately. Like, I mean, now what do you get? You don't have anything to do. But best case scenario, it goes up a bunch, but you're not going to sell it anyways because you're in it for the long haul. So why would you sell it? So really, you're just stuck in a situation. You're stuck between a rock and a hard place. Like you have nowhere to go. But say you buy in chunks. Worst case scenario is as it goes down, you buy more and more. But best case scenario, you're green, and I mean you can't lose. Say you had $1,000 and you bought $250 of Facebook and just chilled for a week, and say it dropped, then you could buy more. Or say it doesn't drop, say it goes up. I mean, then you're green. So there's really nothing to lose. So you should always buy in chunks, because if you buy it all at once, say there's a market correction tomorrow, then you're down 30% and you don't have any cash. It's just not a good idea. Just trust me. So you should buy around like 3 to 4 times to build a position. And kind of tying into that about having cash around, you should always have 10 to 30% cash around. So this is really important because it keeps you calm during downturns, right? So like I said, if we have another market correction like we do in March, if you have all your money in stocks and no cash, you can't do any buying, So, I mean, really it was all for nothing. You just panic for nothing. It's kind of emergency money, and it gives you peace of mind, which is more important than you think, because a lot of investing is psychological. So you should always have some cash around just in case we get that March crash again. You can buy some more of your favorite positions and lower those cost bases. And then just another tip is you should really hold your stocks, keep your eyes on the long term. Long-term gains are always going to be greater than short-term gains, right? If you have a great company that's going to grow in the future, the long-term gains are almost always going to outweigh the short-term gains. So yeah, like I said, you start off with a big name company, right? But then as you start to grow your portfolio, you're going to need more and more stocks. So then you need to start to diversify your portfolio. You don't want to have all your stocks in the same industry. So a lot of people have a lot of tech stocks because they've been booming lately. But that's not necessarily always the case. Sometimes value stocks for a period of time are the better performing stocks. It just depends. I mean, it switches every so often. So what you want to do is you want to have the best stocks of every industry. If you have the best stocks of every industry, no matter what market period we're in, or like where people are focusing on value stocks or growth stocks, no matter what period you're in, you're always going to be in a good position to grow. And just another thing, a couple simple things that a lot of people fall into, like traps people fall into, is when their stock goes down, they sell. Okay, that's the opposite of what you should do. If your stock goes down, you should be buying more. Like I said, have cash around, buy in chunks. It's basically free money, because if you already like the company at their valuation, you already think they're going to grow in the next few years, getting it for cheaper is a steal. It's free money. You just buy more. I mean, that's all you got to do. And same thing on the flip side. If your stock goes up, don't sell. if you really like the company and they're really a great company and they're going to grow in the future, what you should be doing is you should be holding and just, keeping your head cool and focused, because the gains in the future are going to be much greater than the gains of next week, next month, 6 months from now, right? And speaking of selling stocks, there's only 3 times you should sell a stock. Only to build cash, if their business model changes significantly, or if they significantly become overvalued. That's the only time you should sell. So when I say significantly overvalued, I'm not talking like the stock goes up 30%. I'm saying like, oh my gosh, like the stock is like doubled and its forward PE is 300. Like maybe then, you can start thinking about taking profits. But it all depends on the revenue growth numbers and the net income growth numbers. And just a key thing about portfolio management, every quarter you should be listening to your company's 10Q. You need to be updated on how your company's doing. It keeps you up to date on everything, So listening to the conference calls is really important. Reading the 10Q, it'll keep your head cool. So some of my most important advice, I'd say, do not take any steps backwards. We only want to move forward in terms of our money and our gains, right? So some of the worst things you can do that take a step backwards are day trade, options contracts, and margin. Listen, dude, just never day trade. Never trade on margin, and stay away from options for at least your first 3 years. Listen, all those ways are ways people that lose a lot of money very quickly. It's a gambler's mentality. It's get rich quick mentality. No great investor got rich off of any of those ideas. Warren Buffett did not become a billionaire from any of those, and you're not going to either. So just chill out with the short-term gains. I mean, you can try it. But listen, from my experience, from watching people, I mean, I'm in a stock group with people of all kinds of investment strategies. Listen, short-term investing is just not something you want to get into. Take it from the guy who's already been through his first few years, experienced some mistakes, and now is experiencing some gains from following the proper way to invest. Now, some of the best things you can do, and these are very important, very, very important. Some of the best things you can do is treat your brokerage account like a savings account. Add to it monthly, add to it regularly. Be active with investing, constantly be looking into different stocks, here and there, evaluating your portfolio. Don't be jumping in and out of stocks. But, just constantly be looking around for better ideas or better deals. And trust me, if you're doing that, if you're constantly active, you're just constantly going to grow, and your portfolio is going to reflect it. Your portfolio is going to get higher, 20K, 30K, 40K, 50K. And so just constantly be searching for great stocks and great deals. Always be reading. Reading is a big part of investing. It's really underrated. I used to not read it hardly at all, but I took investing very seriously. And sometimes you just need to focus. Play some light music, sit down, read an annual report, get it out of the way. Sometimes you need to do those things. Focus on the future. Seriously, focus on the future, not the short term. The future, all your money now is going to be worth more in the future, right? So saving it now is basically, you're planting a seed for the future, and it's just going to grow and grow and grow and grow. So really focus on the long term. Short-term gains, you shouldn't really be interested in, and they're not going to be better than long-term gains. Just trust me. And then the last thing I'd have to say is trust yourself. Big part of investing is just trusting your thesis, trusting your research. Like if you do all your research, I mean, you could hold an entire portfolio forever, even if they're down 10, 15, 20%, because you know so much about the companies. It's really important to defend yourself against bearish articles or someone who says, that's not a good investment idea, you should have never done that. If you've done your research, you can defend yourself against that. And you're not going to get easily swayed if the stock price goes down or if someone tells you something negative about the company. So those are just some of my tips. There's a lot more I could get into, but for the most part, those are the biggest things I'd say into investing. I could probably have a part 2 of things I didn't include in this. There's just so much. But if I were to put as many important things together as I could, this would be the video of compiling those things. Very important, very key. Just be active, keep adding money to your account, and keep growing. Thanks, guys. And if you like this video, please don't forget to like the video and subscribe. I'm trying to hit 100 subs. Like I said, I have a quality update. Things are looking better. I'm really going to get active with this. I really need to improve myself. So if you have any ideas on how to, get better and be better, leave it in the comment section. And thanks for watching.